We've seen the RBA come out and actually increase the cash rate for the first time after 11 years. What has this done to the Australian property market? Are people scared? Are people already starting to list their prices a lot lower than what they were? And are buyers coming in and saying,
hey, this is a buyer's market, let's buy up?
In this video, I want to discuss what we are seeing around the grounds with the latest amount of data that we've got, and as well as what I'm seeing in our buyer's agency. If you are interested, keep watching. Hey guys, my name's Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I talk about real estate, cryptocurrency, and financial freedom. Now, right now, there's a lot of fear, uncertainty, and doubt FUD around the Australian property market. And it's really about how we expect that because of rising mortgage rates, which we expect to rise to 2, 3, 4%, and some even say 6%, is going to cause a massive crash in the Australian property market. Now, of course, as you guys know, I'm a buyer's agent, so it might be biased here, and I'm just gonna give you the disclosure straight up front is that please do not take any of this as financial advice. In 2020, when I was going out buying more real estate and coming out on the channel and saying, hey, look, I think property markets are going to go up, I started becoming a meme on Twitter for a lot of economists. So again, here I'm saying the opposite of what most people are saying, that I don't think the market's going to crash. What we might see is a bit of a slowdown in how much we've been growing, which is actually a really good sign, and I'm going to touch on that in a little bit. Now, there's no doubt that when you are seeing markets go up by 10, 15, 20% in a year in capital growth, for a market that traditionally grows at like 3 or 4%, you're gonna have some sort of pullback or healthy correction. Now, we know why the asset prices inflated so quickly in such a short amount of time. It was because we printed so much money. Now, as we move towards the new norm, what does that actually look like? Because if we have rates go up by 2%, are we not gonna be back at rates that we saw in 2019? This is where we need to zoom out, and people have a very short-term memory and get way too emotional when they come and approach any asset or investing in wealth long term. Now, here's the first graph I want to show you, which is the housing price growth across Australia. So it's generalized across the market. Now, this is data from about 2015, and you can see on average we had, a few years of 10% growth here, but on average it's probably been about 9%, and we did see a slowdown in 2019. And this is around the time that APRA actually got involved, had started putting in lending restrictions, which basically means that if you don't have ease of lending, it means that you can't really go out there and buy property. Now, I'll tell you why this is a little bit different now in 2022. But even in then, we saw probably a 5% pullback across the market before we started rising again, and then we've had some parabolic moves, especially over the last 2 years. Now, this is generalized. So across the entire market of Australia, we had in some cases 25% growth on average, and now we're at a point where we're growing at about 16%. Again, way above what the medium long-term average is for Australia. Now, why I say that this time is different compared to 2019 when we saw a bit of a pullback, we're not really seeing lending restrictions being utilized, but we also know there's a real severe shortfall in supply of good quality assets, like real estate in particular areas. Now, couple that with the increasing number of immigration that's coming into the system, we have immense levels of demand versus the relative supply at the moment. Now, the other big point that we need to touch on is that the level of funds in offset accounts at the moment are at their highest levels. More people in Australia have saved money over the last 2 years and are cashed up than ever before. So why does this matter? Well, it means that if lending restrictions are there and they're introduced to slow down this market, we have a lot more people being able to plug in money, real cash, versus hoping the bank can give them an extra 10% or 12% on their loan. Now, this alone is not a factor to save this market from a collapse, but you've also got to look at it from a very logical standpoint. The type of people that are coming out and saying the markets are going to crash are also heavily emotional, and they're most likely coming from economists that were already incorrect. And I have a feeling that the main incentive here is for them to overshoot with their predictions, because they clearly know that, hey, if we bring out an article, we look like an idiot, it's okay. We would rather cop that than the actual market pulling back by 20 or 30%. The other factor you need to consider as well is there are a lot of people that go out, take equity from their properties to go fund their businesses. If that business is now going to get affected with higher levels of interest rates, higher levels of expenses as well, then you're going to have that pullback from the property all the way through to the business and all the way through to employment as well. Something else to consider as well is the cost to replace a house is so much higher than it was, say, 3 years ago. You can't simply go out there and go,
hey, you know what? I'm going to knock down and rebuild a house.
You have to think 3 or 4 times. The cost of goods to increase at at exponential rates as well. So the cost to actually go and build a new home has now increased. That's why we're seeing a pullback in the approval of new dwellings. So you've already got a rental crisis because there's a shortfall of supply. You have increasing demand for the existing supply, and you know that the incoming supply is also going to be stagnated because people don't want to go out there, developers don't want to go out there and build property with materials that are at inflated costs. Now, as you know, I've built my foundation, my real estate portfolio in regional areas, and I will continue to do so. Not just because the pandemic was around, but I've been doing this for about 7 or 8 years, and it's proven out to be a really good strategy because I get cash flow as well as the capital growth, believe it or not. And here's a clear indication of what that looks like. So here in the red, we've got the capital cities, and in the blue, we've got regional areas. Now, the reason I like the regional areas is that when things slow down, and you have tough times, people don't necessarily have to get rid of them because the cash flow position on these properties are a lot higher than you do in the capital cities. For example, if you bought a property in Sydney for $1 million and it rents at a 2% yield versus buying a property for $400,000 that rents in 5% in the regional area. That's why you have curves that are a lot less volatile, and that's what I prefer for my foundation. So here you can see, although we had that slow decline in growth in that sort of 2016, 2017 mark, and then you had a further decline in 2019, look at what the blue line is doing. This is the regional areas. You're seeing growth, but it's not volatile. And in 2019, you basically had no pullback. And the reason is, logically, why would you get rid of your property at 20% less or 10% less than what it was last year when the cash flow itself is keeping you in the game? You don't need to put anything from your pocket, and if you did lose your job, you can still fund the property. Now, on the flip side, someone could say,
hey, but Ravi, what happens if your tenant leaves you?
Well, you're in an area that has such high rental demand that even if your tenant wanted to leave, they would have numerous applications coming through for tenants that want to tenant your property. And here you can see when we had that parabolic move, we had actually greater growth in regional areas, and even after pulling back, we're still growing at 20-odd%. Now, could this number come down? I hope it does, because the truth is you can't have sustainable markets grow at this pace. I would love for it to come back into a 5 to 7% growth rate, and with the increase in uncertainty, I think we could probably get there in the next couple of years. But in none of that does that equate to a market crash. And this graph here just further illustrates the differences in areas as well as the regional. So we'll go quickly through this. Where the year to April 2022, all dwellings, the national average was 16%. Capitals were 14% and regional areas were 23%. So this argument that I continue hearing is, oh, well, it's just for cash flow, you're not going to get capital growth, totally alleviates that problem. And if you wanted to zoom out, look back at all the data from the last 30 or 40 years, you'll find that these areas have continued to grow. It's not just a pandemic that caused this. You just got to look at this logically. Now, when you look at Sydney, it's grown at 13%, but the rest of New South Wales at 25%. You've got Melbourne at 9%, but again, the regionals at 20%. Then you've got Brisbane, which has actually performed really well, has gone up by 26% in the capitals and 24% in the regionals. And with Adelaide, you had a similar story as well. And with Perth, I think it's a sleeping giant. I think there's a lot of potential in that market as well. But ultimately, it comes down to what we're seeing on the ground floor. And we have definitely not seen a drop in the demand for our services as a buyer's agent. We know that there's other buyer's agencies also getting huge amounts of demand. And in the areas that we're looking at, we still have high levels of competition. So are we expecting this market to sort of drop? I don't think it's going to drop, but we will see a healthy correction. I will be purchasing property as soon as my refinancing happens, and that's going to basically happen over the next month or two. I'm not someone that's going to sit there and wait to hope that the market's going to correct, because based on what I'm seeing, the numbers are making sense, and with the level of consumer behavior and patterns and trends that we've seen throughout the agency, with that information, we're able to dictate whether the market's going to slow down or not. Keep in mind, when we have had cash rates increase previously in the past, we actually still saw huge amounts of growth in these areas, both regionally and in capital cities. As always, you've got to have a good strategy, good tactics, and a good roadmap. If you need help, there's a link in the description below to our website. We can help you. But what you want to do is separate the emotion from the logic. At the end of the day, I'm not saying that we're going to grow by 30% next year, but I'm also not saying that we're going to drop by 30%. And if you're looking at real estate as the long-term wealth builder for you, then you've got to zoom out and figure out and see how you can weather the storms even when times are tough. And you'll find that the answer is rental demand, rental growth, and having more demand than supply. Among other factors, interest rates are only one part of the entire equation here. And it's very difficult when people are uncertain. They've got fears of recession, you've got interest rates rising, potentially falling as well as house prices and what that means for everyone. Right now, the biggest thing you can do is smash that subscribe button, hit the like button, and I would be taking the same approach I take with my crypto, which is dollar cost averaging into this market. And if I'm able to buy property, I'm probably going to be buying. And if I'm able to get a loan, I'm able to buy property. Well, the best time to buy property was yesterday. yesterday, the second time is today. I'll catch you guys in the next one. Thanks, guys.